Welcome to Entrepreneurs Are Leaders podcast with Harry Sardinas. Interviews with world's most influential entrepreneurs that share tips about how to grow your business exponentially. Charismatic speaking, leadership, branding, marketing strategies designed to help you monetize your knowledge, find true happiness, and manifest your goals and dreams.
Hi, hello, good afternoon, everyone, wherever you are in the world. And today we have a surprise for you. We have a very powerful woman, very powerful speaker. I'm telling you because I have a personal experience because she has been one of the keynote speakers for our gala award that we recently host. So you are today for a treat. You're gonna hear from an amazing person that is not only an amazing speaker, but also she holds her own podcast. She will tell you more about that later. Her name is Julie Wilkinson. And Julie, if you could please introduce yourself before we start to cover what we're going to cover today. What are the 5 key steps that business has to implement in order to make an extra million? Go ahead.
Yeah, hi. So thanks for having me, Harry. So I'm Julie Wilkinson. I'm the owner and founder of Wilkinson Accounting Solutions. We are an accounting and consultancy firm, and we specialize in mergers and acquisitions. So we essentially help people buy businesses and exit planning. We have 2 sides to the business where we do sort of traditional tax accounting, and I have 2 missions. One of my missions is to save the world from failed acquisitions, because I think there's too many courses teaching people that they can buy businesses with no money without really teaching them the reality of how to run businesses without cash flow. And the second is to help investors and owners become more financially literate, because I see hundreds of balance sheets, or have seen, and talked to hundreds of business owners through my podcast. And the common theme I hear, especially in the UK, is that I would say 98% of business owners or investors don't truly understand financial statements when they sign off their accounts. And that is what causes the problems when they eventually come to exit and the valuations change. So they're my 2 main missions. I'm a chartered management accountant by trade. I came from corporate. My last corporate company, I worked for a 250 million group retail company. But we've chosen to work more with the SME market. So at the minute, we typically work with businesses probably from about on acquisitions, probably from about 500,000 through to, well, somewhere between sort of 30 to 50 million, although we can do larger deals should we get asked, but that's a sweet spot for us because we feel there's a bit of a gap in the market. Alongside that, I also am a property investor, podcast host. I host the Build and Exit podcast. So we have guests that talk about acquisitions and exit planning. I have an investment in a tech startup firm myself. And I'm a professional speaker, and I also do a bit of mentoring and coaching through the acquisition process as well, because I have acquired businesses in my company too.
Wow, that's amazing. That's amazing. I think that, that actually I also invest in a tech company. I'm actually the CEO of that company. And we also do property as well. So we do have a lot in common, more than what I thought. There is something, however, that at the initial of my career, and I still is always been a pain. And regardless, I'm an engineer actually. So I supposed to love math and to love and to love all the numbers, right? And I do like, but wow, when it comes to the accounts, I think that I think that the whole thing started with me and the accounts, because the accountants always telling me what to do. And as a business owner, you don't want to hear from anybody what to do. And I'm talking about 15 years ago when I started to go to the accounts, and the accountant, don't do this, don't do that, you have to do this, you have to do that, and you're running the business, say, oh God. And it was a little bit overwhelming, and this is the part of the business that I find it more challenging.
Yeah.
In myself, there are the challenging to deal with, right? Probably is my own experience, and probably I don't blame my accountant. He's trying to do my best, right? But I think when you're navigating in this entrepreneurial, right, and like most of the people become an entrepreneur, like I become an entrepreneur. Like, you do by accident. So you design a product, you sell it. There you go. You make a little bit of profit, and you are in business. And then you are an entrepreneur by accident, right? And
Yeah.
then you had to learn everything. You had to. I mean, the accounts was the last thing. After a year, a friend told me, "Have you do the accounts?" I'm like, "What's that?" I said, "No, you have to submit. Submit what?" You know what I mean? So, and to go to all this process at the beginning, I think that for the small business is a little bit challenging. And so my question to you would be, number one, we want us to you to share what would be the 5 steps, right? That the businesses from the startup or from $500,000 onwards, how they can make an extra money, right? An extra million. And what would be that process where you truly made your accountant, because today is my right hand. You know what I mean? Today we don't do anything without the accountant, right? But things not always have been this way. At the beginning, it was a very difficult relationship until the entrepreneurs find out how will be the end result. So what would be usually the 5 steps that will help the entrepreneurs to navigate that rejection or that lack of knowledge, and actually make it from the people that is the last thing? Because when I started my business, the last person that I wanted to see is the accountant. Yeah. Until now, which is actually it become your right hand, and you talk to more often, and it's actually a key part in the business. So how we achieve the transformation that we help the people to make an extra million?
Yeah. So, okay. So I would start with planning. So people often get confused with business planning and financial planning. To me, they're one of the same. They're one of the same document, but they focus on different areas. So business planning would look at the where, who, why, and how. So they'd look at why you want to do what you want to do. How are you going to do it? Who do you want to work with? So, the common things: who is my customer? How much am I going to charge? And sort of the why. I suppose the financial planning is then, so what is more the financials around that plan? So what will I have to charge to run my, to make the money that I want? How much do I have to spend? And how much cash do I need to grow it? And I don't think you can really have one without the other, because I think I would say typical entrepreneurs probably go towards more the business planning because it's more the fluffy stuff. But the fluffy stuff doesn't work unless in the end you have the financials. And I think people take a long
100%.
time. I think people can take a long time to get to where they want to be because they don't really have the structure behind the plan. So that's what I would say. So I think you have to have both of them. And I would say how we would typically advise is the reporting, or what we would recommend in place, is you have a shorter term plan in detail. So we would expect 12 months in a lot of detail. So 12 months would be literally calculations. I'm going to have this number of customers at this price, through these channels, these budgets, detailed workings. So you can really show your ins and outs, especially over the first 3 months. And then probably an extension, which we'd then say would be a top level plan, which is like a 3 to 5 year plan, which would be more top level extensions on the detail to say, okay, so if I then grow this consecutively over this period of time, where's my end goal? So I would say you work backwards and forwards, because you want to go, where do I want to be in 5 years? Maybe that's your million. I want to be my extra million or my million. And then you kind of work back. So you work forward. So you build your plan on paper, but then you've got to see, well, can I get to my million? If you can't get to your million, then you start coming into the next steps. So that for me would be step 1.
I think that is very important, and thank you so much for sharing, because it's exactly what you share what actually happened. Yeah, business plan, everybody love to do because it's all the fluffy. You just write part out of there. This is what I'm gonna do. Now, when it comes to financial planning, I'm aware that very, very little people do this, or very little people actually don't understand how important it is in creating your foundation for your business.
Mm-hmm.
And I think that these a lot of entrepreneurs miss the second part. I think that the part of the business plan, they do it more or less. I think that some people, usually some people put a small part of the financial plan inside the business plan, and they think that they cover that. They cover a lot, but I think that what you say is key. Actually, the financial planning has to be with lots of details, right?
Yeah. And actually, financial planning often is more important than business planning
There
to an
you
extent,
go.
because that's the foundations. So I suppose this then comes back to the advisors, because, you know, like you say, people might not even have an accountant at this stage. I mean, one of the reasons I started my business, the accounting firm, was because of my skill set, because I did a lot of research into the market of what you'd call sort of traditional practice accountants. And I'm not saying that none of them can do it, but you can't really teach. You can't teach experience, you know. And I had 20 years working in corporate firms where I did hundreds of these plans and hundreds of cost stats. And I've worked in every finance department you can work at, from purchase ledger all the way through. And when I did research on what sort of traditional accountants was, what they sort of saw was business partnering, financial plans, management account, wasn't what I knew it to be, because I saw a completely different side of it, which they haven't got the experience on. So this is where you come to, what are your advices? You know, would your accountant do that? I'm not saying none of them can, but are they as good as someone that's got the experience? And that's why we're quite popular for these types of planning and reporting, because we have the skill set and the experience, not just to build the numbers, because building the models is one thing. It's the commercial and sort of overall business experience in terms of how that might, you know, challenging those numbers, I suppose, is probably where it comes down to.
Exactly. And then so you can, this I can tell you because I know a lot of accountants. I have trained them, loads of them, and I think that you are one of the first, probably the first person in this background that I saying something that is really true, that actually the financial plan is actually more important than the business plan. Because it doesn't matter what you write in that business plan if there is no financial plan. The thing is that a lot of people don't talk about this financial planning because they don't know how to do it, right? Again, it comes with experience. And that's why a very key element of the foundation of the business is left out, because people don't know how to do it. People have very little knowledge about it, or they don't know how to do it properly, if that makes sense.
Mm-hmm.
And that's why the business can suffer. Yeah, I think that this is very strong point, number one, that actually make you different. And you know, Steve Jobs always said, you don't have to be better than anybody else, you have to be different, right? And when that strength that your organization has, creating this financial planning, yeah, as a stepping stone, of course, along with the business plan, but look into details, yeah, how this will be the core stepping stone of the foundation of the business. I think it's spectacular, yeah. So now we have an amazing financial plan, and then we have a business plan. So what happened next?
Okay, so I would say stage 2 is then looking at your investments and your advisors, because I think too many people rush in to do everything. I think it's really important for people to look at what is their skill set and what do they need help with. And that's why I suppose you kind of have to do step 2 in line with step 1 to a point, because who you need will be in the business plan, but how you afford them is in the financial plan, because that's the question. So when I speak to, especially to more startup businesses, because I speak to quite a lot of them as well, because we do work with smaller businesses as well, I think the problem people have is their first thought is just to pay themselves. But the problem with that is, to continue to grow, you can't only just afford to pay yourself, because the fact is growing costs money. So to have money to grow, you've got to have additional cash to then invest. So from the start, you need to be pricing your products and service, not just to cover you, but to be covering all your overheads, and how does it retain cash after tax to then invest, which is why the financial plan is so important, because unless you sort of bring that out on a spreadsheet or calculate that somehow, you can't possibly know. Not really. You could maybe give an estimate in your head, I want this amount of margin, but a lot of people forget the overheads and forget the fixed costs. So then I suppose the fact is sometimes you have to go to market potentially doing some free stuff, or it's goodwill prices or something to try and get market share and things like that, and that's fine. So it might be you can't market your particular thing full price or feel like you can at the beginning. So how do you then grow that eventually to get to where you want to be? And that's where you've got to plan it in, because you've got to look at, okay, so where's my premium market, where's my minimum price, and how do I get from there to, and who do I use along the way to get there? That's my advice. So you have to start pricing these things. So for example, are you doing the bookkeeping yourself, or are you going to outsource the bookkeeping? Too many people think, oh, I can't afford to spend whatever that bookkeeping charge is. But I'm like, can you afford not to? Because ultimately, yeah, that might cost you £400 a month. But theoretically, if you're not trying to do that, you should be able to earn more than £400 a month. So when you come to plan it in the first place, plan those scenarios. Okay, so if I do the bookkeeping, I don't pay the £400 a month. But if I don't do the bookkeeping, I'll get this amount of time. And what people are actually saying is they're not planning their time well enough to make use of that £400, because if you were really planning your time, you would be able to afford the £400. Do you know what I mean? Or what, I'm just making that up, but you know what I mean, the extra bookkeeping costs of whatever that might be. So I think investments and advisors, because you've got to work out, but also what's your skill set, because you probably can't outsource everything at once, because you are going to need money for that. So you've got to start deciding what order. And then you have to stick to your order. You have to sort of stick to your plan. Is okay, so I need to get to here. I need this money. I'm going to do this. I need to get to here. I'm going to do this. And that is why your financial plan has to align to the business plan. Otherwise, how do you know? And that's why your first 12 months is in detail, by month, even potentially by week, potentially depending on if you're doing products or services for cash flow, so that you have real specific targets for yourself.
Yeah. 100%. I think that pricing is a very, very interesting topic, because I remember that I remember when we operating a property business, we sold over 5 million. That was my first business, and I remember in the credit crunch, right? Was obviously what, so people have less access to money. And I decided that I'm going to decrease the price of the rooms. Yeah, we were part of my property company was renting rooms, right? And we decided to lower the price, right? And what happened is we lowered the price, and still we had the same amount of rooms empty. And I'm checking, and I said, then is no, my problem is not the price. My problem is the capacity that I have to acquire clients that have nothing to do with the price. And so personally, right, I learned by experience that sometimes, especially when the startups, people tend to put the price cheaper, right? So you say, well, I'm starting, so let me sell my product cheaper. And then they fall into the trap that because they're selling the product cheaper, then they cannot cover the cost that the business needs. Because if you have the accountant, the accountant can save, £400 a month, can save you thousands. So that money should be allocated there. But of course, if you don't have the right price, you won't be able to cover that cost. And we tend to think that, okay, let me put the price cheaper so people can buy more. And it doesn't work like that. It comes to branding, it comes to your capacity to acquire clients, and that has nothing to do with the number. Actually, 80% of the people don't buy on price. If you see the cars that everybody is driving, or the watches that everybody wears, or the clothes, or look around yourself, you will realize that you listening here, the probably in the 80% that doesn't buy on price. because we buy, all of us, 80% of us buy on value, right? So how much value can you make for your money? I think that when Lily, I live very close to Oxford Street, and I go with Lily sometimes, and Lily go to buy the dresses. Yeah, I don't like to go to the shops that much, but Lily goes inside one shop. She look at the dresses. She go out. She goes inside another shop. She look at the dresses. She go out, and like these 10 shops, and I'm analyzing her buying behavior, and what she's doing, she's looking for value. She's looking for the best value for her money. Of course, she likes the dresses. She likes all the dresses. I know that for a fact. But she's looking, okay, I have this money. Yeah. She's not going to buy the cheapest dress. She's maybe not going to buy the most expensive. No, but what she's buying is how much value can she get for her money out of the dress, right? And that's why she looks at different options. And I think this is our buying behavior, right? So when we buy something, 80% of us, we don't buy on price. We buy in how much value for money we can get out of the product, right? But again, 100% agree with you, Julie. If the price is not correct, because the entrepreneur is not communicating the value effectively and create this capacity to attract clients, right? That was my problem. I was not communicating my value effectively. Yes, I was selling my rooms at a price. Then I dropped the price. Then the room is still empty. I have nothing to do with the price. It has nothing to do that I'm not communicating the value effectively, and I don't have bigger capacity to attract clients. That nothing to do with my price. But then it was worse. I dropped the price, and then the sales drop, and I have less cash flow. Then we're struggling to pay the accountant. Are you with me? So the whole thing went to an end. So I think that this second point that you are sharing with us is very important, like pricing, and and you definitely need an expert for that. But pricing your product at the right price is key in order for you to survive in the marketplace, and not because you are starting, you have to put a price that you will be able to operate, or otherwise is not going to work. It's very difficult. Pricing is really, really difficult. We have hundreds of products we sell all the time, and to get the right price is the PhD, but somebody, for you that listen, if you're lucky, and you want to get the price right, contact Julie, and she can help you with that. Okay, so step number 3, what else can we do?
Okay, so then I would say step number 3, so you've basically built a plan, and you've got your targets, so you've looked out 3 to 5 years, so you said, this is where I want to be. I think the next thing then is to decide, okay, so what is the fastest and quickest way for me to get there? So often businesses can't grow, and I'm a relatively early stage business, so I have these plans in myself. Often it can be very hard to grow organically to get to 1 million. It can be hard to get past 500,000 because the cash flow investment required and the overheads required to get there is so up and down when you're sort of doing it organically for a sort of an organic sort of business to get there. So what you've got to do is you've got a plan. This is why you go further out, so you can see a bit further ahead, so you have a bit of time to make decisions, really, so you're not firefighting all the time. So you go, right, if I continued on my organic stretch, can I get to my 1 million? Let's just say the million's the target. Often people can't, not very easily. Similar for us, we would struggle too. So then how do you do it? So that's where you start bridging the gap. So this is one of the reasons we specialize in acquisitions, because acquisitions, as an example, is a very quick way, can be risky, can be high risk, but high reward way to get to your goal. So like, for example, if you get to 500,000 and you're covering your current cost base, let's just say a service-based business, so you're now making somewhere between a 30 to 40% net margin, and you're covering your cost base, to do it organically is quite a big risk, because it will probably first be you have to invest in the people first, because normally you have to bring people before you get clients. Well, a large volume of them, maybe not 1 or 2, but a large volume. And that's obviously higher risk, because then it can be a good 3 to 5 months before you get those clients. And now you've got this cost base of potentially 4 to 5 grand more than you had before. And that can be quite hard for a small business. So therefore, the reason you do the acquisitions is the acquisition then buys those clients, 2Ps those staff, and you effectively bolt it onto your existing business. And then, so let's just say you bought a business worth 500,000, you've got 500,000, you're doubling it pretty much overnight, although you'll have deferrals to pay off. So cash flow wise, you probably won't see the benefit of that potentially for 2 or 3 years. However, if you manage it right, you've got to look at a bit of a longer term gain of where that business is coming from. So, and then I'll go on to my next point, which then says how you can improve the margins of that acquisition. So I'm not going to sit here and pretend it's fully easy. I mean, I've done it myself. I bought a business last year. We've been integrating it. We've just cut £5,000 a month of our overheads. It took us 11 months. We had to manage that cash flow. And we're currently in the conversation of our next acquisition. We're at heads of terms now, which it's still in progress, but if it comes off, that should take us around we should then be at around 650 to 850 turnover sort of thing. And then we'd be looking to do another acquisition, which would then take us over the 1 million mark, and so on, so on. But I didn't start I've only had the business 4 years. It probably took me a couple of years to decide what I really wanted to do. So I took my time. I never was one that took on hundreds of clients immediately. I did high consultancy projects so I could get just cash flow in so I could sustain. But in 22, I made the decision. We built the team. So then by March 23, we did the first acquisition. And now we're 1 year in and we're doing the next acquisition. And I'll be, probably within my 5 to 6 year plan, I'll still be relatively where I thought I'd be when I started.
Wow, that's fantastic. And yeah, I think that sometimes acquisition is the only way. For example, the tech business that I invested, oh my God, we desperate. We're looking to do a merger and acquisition because we are in the situation, for example, that we have a very good product. We're actually working with Greenwich University. Or the product that we have is to create 3D content for the metaverse, for the movies, and for the gaming, right? It's multi-million pound scope for that business. However, you are in the situation that even though we own the patent and everything, you need to find the clients, right? And it's difficult because the clients for this type of product, they will spend 1 or 2 million or 10 or 50, right? Could be Disney, could be these big clients, right? And none of these companies will actually buy a product with a startup that have 8 people, you know what I mean? So now you are in that gap, that the only way that to move the company forward is to do a merge, right? Or to do an acquisition, like you said, to someone that have the client base, because you have the product. But if you have a very good product, but then you find another company that have all your clients, yeah. So of course, if you do a merge and an acquisition, then you can not only double but also save the company, if that makes sense, right?
Yeah. And I think the thing is, people just, and this is where I think sometimes the courses can be misleading to people, because they're all teaching, don't buy a job, buy an asset, buy a business. But, that's why I like my podcast. I've had guests come on the podcast that didn't feel comfortable going and buying a £10 million business. And at the end of the day, the risk comes with the reward, because ultimately people say, yeah, but if you buy a bigger business, it's ran better. Well, is it? Because I've worked with businesses of 12 to 50 million that still write their marketing on a whiteboard. So you can't necessarily just say that a bigger business is going to be ran well, because in the UK, we're quite far behind exit planning. And typically, even larger businesses aren't still run effectively. And therefore, yes, okay, fair enough. I could go out tomorrow and buy a 2 million business, but it comes with other constraints. So it comes with, are you the market leaders to buy them? What risk does it have then with those businesses, if they don't maintain, or they're not as profitable as they're saying, or will they be as profitable in your group? There's other things to consider. So I don't think people should feel pressurized to rush. At the end of the day, you do what's right for you in the acquisition. So you don't have to go out and buy a 10, 15 million business, a smaller business. And it's also what you're passionate about. I mean, for me personally, in my acquisitions, I'm passionate about changing the accounting industry. I don't think the service is particularly great from what I see. And I feel that, at the end of the day, the business we bought 100 clients, and all of them were paper-based. And we've now managed to get 60% of them online. And so I am partly interested in acquiring because I also want to help the clients I'm acquiring. I'm not just in it to go, I want to just buy this X million business just so I can say I've bought a business, because I think you have to be passionate about what you're doing as well. So I think the one thing I would say is you don't have to feel pressurized. Acquisitions can be for everyone, whether it's a little small tea shop that you buy by the seaside or you buy a 20 million business. It still does the same thing for your dream, basically.
And sometimes you recommend the acquisition or the merge. I think, for example, I in the tech industry, I'm very involved in tech, and I know businesses there that that they acquire, and then they create a big hub, and that helped them a lot in raising the funds. So.
Yeah, well, there's a way to do it. So most people would set up a holding company that has a group structure. So I think mergers, that's why it's M&A, mergers and acquisitions. Mergers typically happen. A merger to me is where you buy part of the shares of a larger corporation and you merge it into your company. I suppose an acquisition is still, if you buy 100% of the shares and you merge that into your group, to me, that's still an acquisition, because an acquisition is 100% share purchase where you buy the whole goodwill of that company. You might then, how you acquire that is then down to your tax planning and your group and your cash flow planning in your group. But I would still class it. A merger to me is more where you buy only part of consideration of a business. I think that more typically happens either in larger corporations, or it might be a negotiation with the owner. So like the owner you're buying off might say, well, I still want to retain 25% and you might only buy 75. However, as long as you've got controlling interests, you're still, you've still got control of that business. So that's where I see the difference.
And for example, Julie, if let's suppose if somebody listening to this podcast, right, they have a company, right, and they have the interest to merge, yeah, or to be acquired for another one, right? Do you, in as part of the services that you provide, if this company goes and give you all the details, that what they have, the balance sheet and everything, do you think that you guys can be able to assist them in find that other company that will match perfectly with them?
Well, we don't broker deals, but although we're very well connected to brokers that can, so we have helped people. We have helped. But not per se. Where we typically help is we basically help people if we're going to work, because we do work on both sides. We can act as acquisition CFOs for buyers, or we would act as the advisor for the sale. Obviously not on the same deal, because that would be a conflict of interest. So it depends who gets to us first, really, because we do work on both. Now, if we were going to do an exit plan, our aim would be probably a longer term relationship with that client, because we see the value of the business comes from transitioning that business from a lifestyle business to an asset. So I see there's three types of business. There's three types of owners. There's owner operator, which is where business owner is fully involved in their business. There's board member, where business owner has staff, so probably doesn't do all the day-to-day operations, but still makes key decisions. So maybe still makes the payment run, decides who they're going to pay, probably makes bigger decisions. But then you have silent investor, and silent investor is then where you still own the shares 100%, but have no involvement in that company. And I think that silent investor is where you get the maximum value on exit. And obviously you have to have that journey. And that's not an easy journey. You're looking at 2 to 3 years, probably minimum, to get from owner to silent investor. And we would help people build that infrastructure around that business model to help them transition. So we would help them do things like look at the budgets for the people they need. We would help them look at the corporate governance, segregations and controls they need in place so that the owner felt comfortable relieving tasks. So, for example, if someone was going to place an order, send an invoice to accounts and pay it, would the business owner feel comfortable not having any involvement in that process? Probably, I would say most people would say no, but you can build the right segregations and controls in place so you do feel comfortable, so it reduces the risk of fraud or error, basically. And we would help them implement that. We would help them look at their systems and their processes and the reporting. So we'd look at what's their KPIs, what systems do they have, and how do they report effectively on information, because we would help them gather that information. We would help them look at valuation, so we could ongoingly keep looking at valuing. Obviously, we could do the back office, so bookkeeping and things. And we could also help, because we do sort of pitch checks and valuation reports. So we do eventually help people, and we would do it slowly, because we would see that, first of all, you need a basic month end. A basic month end is a management accounts with some KPI reports. Once you have that in place, that effectively can become your exit pack. So eventually that would become your exit pack. So so if we were going to work with an exit plan, that's the type of thing we'd be working with, is help them set up those things in place, because that's how you maximize the value. Because when people say, there's a lot of hearsay is, oh, what will someone pay for my business? I mean, there's two things in my mind for evaluation. There is an average EBITDA, which is obviously your profit, your earnings before interest, tax, amortization, depreciation. And the first question is, are your accounts right to get to that average? And that's basically the accuracy of your bookkeeping, which is what I said in the first instance, is where people aren't using the right advisors. But once you get to that average, the next question people go is, well, what will someone pay for it? Well, selling businesses isn't like selling a house. You can't go, my mate down the pub sold it for, I will sell it for 5, because everything could be completely different. Like, who runs it? How do you price? What systems have you got? How manual are things? Like, all of these are then goodwill that someone's willing to pay. So we think, well, I believe, and this is what we do, is if you set it up effectively, then you'll maximize the value on exit, because it's now an asset effectively, and it's not an owner lifestyle.
So we say that the third step, so we have our first step, which is that when the entrepreneurs, start the process, they have to have the business plan, but most important, the financial planning, yeah? And then to the step number 2, which is get the price right, so you can afford the expenses that you're going to have. So what would you say that would be the step number 3, Julie? Would be
acquisitions.
Exactly.
Looking at acquisitions, or the growth strategies to get there.
Growth strategy for the acquisition. And for that, to look at that, they have to either contact you, and then you can contact brokers in the industry, right? Because I find it really, really challenging for companies. I think it's like dating, right? It's very difficult to find, or challenging, right? To find the right match, right? When it comes to company. So, but if with the right contacts, with the right brokers, that they can facilitate that process. Is that correct?
Yeah, correct. Yeah, to find it, correct. But I think the key question is, does the person buying it actually know? Because I find it quite astonishing how many businesses are going to market and doing acquisitions but don't have a plan. So how do you know who your perfect buyer? So how do you know who your perfect seller is if you don't really know what you need? Exactly. And that is a common. So I do think, and it's quite interesting, because there's been a lot of buyers out there that are sort of penalising sellers. Old sellers never have their information, they can't give it, but yet the buyer themselves doesn't have that in their own business.
There you go.
So it's like, before you start going to market and expecting sellers to have this information, you should really have this in your own business. So if you don't have basic business planning, basic management reporting, and basic cash flows, I personally don't think you're ready to buy, because how can you go to a seller and expect a seller to just go, oh yeah, I'll give you my business? You're saying to them, I want management accounts, I want cash flows. But if they said to you back, well, can I see yours? It works both ways. That goodwill that trust goes both ways. Yeah, the seller wants to know, you actually run my business, and you as the buyer want to know, am I buying a good business? So that goes both ways. So I do think it's interesting, the acquisition market and the expectation of buyers when they don't always have their own ducks in a row.
Interesting to know. And then it comes to evaluation as well, yeah? So how can we get the inaccurate evaluation? What is the best way? Because that's the other thing, that people value the business in... sometimes they are emotionally attached. They have put a lot of time and effort, and people think that the business worth a lot more than it really is. So what are the key points that we determine? It doesn't matter, especially in tech. We see that a lot.
Yeah.
Yeah? In tech, we see that people multiply by 20 EBITDA, right? And as a company with zero sales, the valuations are huge. Yeah, we understand it's technology. They get value high. But do you have like a certain tips that people can use to actually value the business right, so they
Yeah.
make sure they're paying the right money for it? Yeah.
Funnily enough, I actually have a training called How to Understand Accounting Lingo, which is online, which people can download, which helps with understanding financial statements. Because I think the basic principle of valuation comes to, do you really understand financial statements and accounts? Because this comes back to the point I said right at the beginning, do business owners really understand their accounts? Well, I always get told when we first work, oh, yeah, I do. But actually, when you challenge owners on their numbers, they don't. So they get a profit number, they get a tax number. And I think fair enough, they understand that. But I think it's more the balance sheet. I think the problem comes is the balance sheet, because it is complex. And ultimately, unless you've trained in it and you understand it, how would you know? And it is quite difficult to explain that. So I think I would say for sellers, I feel sorry for brokers really, because they get a bit of a bad rep because they're like, oh, they're overvaluing the business, but brokers aren't financial experts. My opinion is sellers shouldn't be going to market if they don't know their valuation, because they shouldn't be expecting the broker to value it, because they should have their exit pack and their valuation already in place. And they're doing themselves that a disjustice because they're slowing their own process down. So anyway, but when it comes to valuing the business, so I would say, if you don't really understand financial statements well enough to assess the balance sheet, then you need to get an advisor to do it, because the biggest risks comes in the balance sheet on the accuracy of the historic accounting. The methodology for valuation is generally an average of an EBITDA multiple, which, like you say, can vary in different industries. We've actually worked with tech companies and we've seen 6 to 10 times valuations in tech, for trading tech, but average industries might be 3 times. Some businesses might be more, and some businesses might pay more for standard basis, depending on how well they're ran. Obviously, some industries are valued on recurring income, and then some businesses will be valued on future performance if they don't really if they're more of a loss making, because, like you say, like the tech. But I think ultimately it's can you assess a set of accounts and know the intricate bits of where the risk might come. And I do think often standard business owners can't, because they don't understand financial statements well enough to know whether the amount, they understand the bank account, obviously, and probably the fixed assets, but it's all the others: accruals, prepayments, deposits, deferred income, deferred tax, uncategorized assets, uncategorized liabilities. Like, it's all a bit of a minefield. And invoice factoring, financing, like, how do you assess, are those numbers right?
Do you think that evaluation for a tech business 20 times EBITDA, do you think that is way too much, right?
Well, I haven't seen as much as 20. I think the most I've seen is 10. I don't, but again,
okay, let's start with 10, yeah?
Yeah, well,
so
I suppose
it's reasonable?
Well, I think it depends who's buying it. It depends who's buying it, because this comes down to who is your buyer. The fact is, people can't often have the fluffy stuff with the money. So you got to look at from the buyer's perspective. If a big corporate PLC saw a tech company that had already built all the technology, if they could take that company, get rid of all of their overhead, so basically get rid of all their staff and just increment that technology and then grow their business 10 times over, would they pay 10 times? Probably, because why wouldn't they? However, will the seller keep the fluffy stuff? Will they keep the brand? Will they keep the name? Will they keep the stuff? No. So you, as the seller, have then got to decide, well, what do you want from your sale? Is it purely money, or do you want the brand, and do you want to keep, your sort of small family business? Typically, if you want that, it's normally sort of more, you need to be getting someone to buy that's more an SME owner, not really some sort of corporate business buying it. So I think you've got to depend what you want. But yeah, why wouldn't someone pay a lot for it if they can get rid of it all, and they can just implement that? So again, it depends who your buyer is, because in the same scenario, if an investor came, they didn't really have that set up, then obviously they're not going to offer 10 times for it, are they? Because they won't benefit from that investment. So I think the seller has to decide who they want to sell it to.
Very good. Okay. Okay, so the step number 3 would be prepare yourself for acquisition, and that this step 3, it has a lot of things inside, which is prepare yourself for acquisition. Is not just go and look for a business to acquire. First, you have to be ready yourself and have your valuation and your things in place, and you have to have clarity of your own exit plan even before you go out and
I
source
think
for other
so.
businesses. Yeah.
Yeah, yeah.
Yeah. Now, Julie, one more question. Yeah. Is it possible that sometimes you can buy the business for very little money?
Oh yeah, you can. You can buy the business with very little money. You can buy the business with no money, none of your own money. But I just think people have to be careful of what that means post-acquisition, because I'll give you a scenario of how it works. So how you can buy a business with no money is effectively if you buy an asset-rich business. So let's just say you buy an engineering firm. What would typically happen is you'll do a deal with this buyer. So let's just say you buy it for $1 million. Okay, let's just say it's $1 million for simple terms. And let's just say you agree to pay 50% upfront and 50% on completion. That's quite high probably, but just for simplicity. So we're now saying $500,000 each time. So what would happen is, first of all, you've got to find the first $500,000. And if they're quite asset rich and they've got no funding, that you can refinance those assets to leverage that 500,000. And also there might be cash and stuff in the bank, but let's just say that other 500,000 is then what you call seller financing. So it's basically on deferral over a period of years, interest free effectively. So obviously the more you can get on the seller financing, the benefit, because it's interest free. But then that depends on the negotiations and what business you're buying. But
it's actually possible, right?
So that is possible. But the thing you've then got to remember is you'll now put constraints on the business, because that business didn't have a $500,000 loan before you bought it. So how does that business then repay that $500,000 and the $500,000 to the deferrer? It's still got to pay $1 million. Now, theoretically, if you look at a business with $1 million turnover, so let's just say it's $1 million turnover with 300,000 profit at 30%, that's getting you to your 1 million, because that's your 900,000. Okay. That's a 30% margin. That's a lot of years profit that you've got. That's 3 years profit to pay back that 1 million. So if you're going into it thinking, oh, I'm going to get my money from this, how? Because if it wasn't paying you before as the investor, and now you've got £1 million business that makes 300,000, that 300,000, you'll have to pay that $1 million back over 3 years. That's basically all of your profit gone for the first 3 years, cash profit. But it's fine, because is it still worth doing? Well, of course it is, because then you're going to own £1 million business after the 3 years.
Exactly.
But can it pay the interest? Because now you've got $500,000 with an interest rate, probably of current market's 15%. So now you don't only pay back 500,000, are you? You're paying back probably another 50,000-60,000 over that 3 years. How does the business make the profit to then pay for those things? So it's doable. That is how you buy it with no money. So you can do it with no money. I've been involved in loads of those deals, but you have to be careful. And if you don't want sleepless nights post-acquisition, you need to be very well planned and understand the risks, because that's what often these courses that are teaching people to buy businesses aren't telling them.
It will work only, Julie, if that business that you're acquiring have a large client base, right?
Yeah, well, it works when you can pay. It works really on how you can grow that business after the acquisition, because the reality, really, I think you have to be able to add margin onto that business after you buy it to sustain that acquisition and then to grow it. And most people are going into acquisitions because they see a way that they can then increase the value of the business they're buying. And I think that's what but the reality is how, because I also see a lot of people say, oh yeah, I'm gonna grow this business 3 times in the first year. And I'm like, but what happens? Yeah, but what happens if 5 staff leave and they can't cope with the operations of the current business? So, you've just got, that's why risk scenario planning is probably one of the most important things in acquisitions, is what happens if this happens, and what is my worst case scenario? Because that's what you want to know.
Exactly. Yeah.
So
very, very interesting. Yeah. Okay. So after we set up our company and we are ready to acquire, to start the acquisition process, and you have your own exit strategy. So what would be the step number 4?
Okay. So then I would say, so let's just say you've done your acquisition. we then start looking at cost reduction, because I think cost reduction's important. But I think when people are struggling, they make too many rash decisions and cut costs immediately. And cutting costs isn't always the best way. Obviously, long term, everybody wants to cut costs, but you have to be sensible. So when you do it, so let's just say you do an acquisition, probably long term you will cut costs somewhere, because you will consolidate, you'll get economies of scale. So things like you might get group insurance policies that reduce costs. But when do they run out? If you buy the business month 1 of an insurance policy renewal, don't have in your plan that you're going to cut insurance by month 3, because realistically you're probably not, because you're probably engaged for a whole 12 months. And these are the things that people rush into and they don't really think about it properly. But cutting costs will be then one of the good things to make more profit. It maybe doesn't increase the revenue, but there's no point in having revenue with no profits, because I've seen businesses get really excited because they've increased turnover by 30,000 a month, but then that costs them more money and they actually make a loss. And I'm like, that's just busy fools. So there's no point in doing that. So sometimes it's better to grow a bit slower, and I think, and get the cost base right to get the right margins, than it is just to rush and keep growing when then you don't make any money, because that's just pointless as well. So I think it's a mix of both. So I definitely think cost reduction is one. And to do that, you just have to do a deep dive into all your overheads. And this is why you need good management reporting, because you need to really know what are you spending and on what, and how can you reduce that cost to then make more profit. So it might not increase the turnover, but it will increase the margins that you make on those turnover, which I actually think is more important.
Yeah. So actually, because one thing is, I think that theoretically you can say, okay, if I put my hands in this business and I can change this and this, I'm going to reduce the margin. But once you are inside the business, I agree with you 100% that, the cutting of the cost and to increasing the margin is a process that has to be gradually done until the people don't understand exactly the business. Yeah.
Yeah. And I say cost reduction, but I don't always mean reduction. I mean, I don't know the word you use, being sensible, effectiveness, because it's what are you spending it on? The amount of people I speak to that go, oh, they spend thousands on marketing, and they actively just tell me, oh, it never works, but I just keep going. And I'm like, well, why? If you're spending £5,000 a month on marketing, it's not working, well, stop. But that doesn't mean you don't need to spend £5,000 on marketing. That's why it's being sensible. Some people will just go, oh, I'm making no money, I'll cut all my marketing. But that obviously doesn't help for the future. You need the marketing in place. But the question is, so rather than make the rash decision, take a few days out and actually go and sit and think, well, why is it not working and what should I do differently? And what advisors do I need to pay with that 5,000 to make it work better? That's what they make too many rash decisions and don't make it. So it's not always about cutting costs, but it's about revisiting how you're spending that cost to make the best use of that money.
And talking about marketing, you see, sometimes the best marketing strategy could be acquire business. I was doing a conference last week, and it was about property investment for the Latin American community. And it was one company there that they were doing property maintenance. And after they came and spoke with me, and they told me, Harry, you won't believe what we did. I said, what you did? I said, we acquired home insurance company. And now they are in the position that they have a home insurance company that have the landlords, and they also do property repairs. So now they acquire a lot of new clients that they didn't have, because they have the same customer, right? The same client base, but the business they're not competing with each other. It was an extra thousands of clients that they got by acquiring that home insurance. And this is way better than any marketing strategy. They will never get all those clients with any marketing strategy so fast, especially a business that only has a year operating, right? So they didn't have the credibility or we can say the whole experience to acquire this amount of clients so fast, or prospects. And because they have this home insurance company that they acquired, they now stronger, they have big evaluation. Now they end up with a lot of clients. And so sometimes maybe the best marketing strategy is to acquire the right company. You will save a lot of money in marketing, because let's say the truth, and the cost of acquiring the clients in any industry, especially in tech or any industry out there, is extremely high.
Yeah, I think if you bought a 500,000 business, you'll probably be looking at fees of between 30 to 50,000, I would say. However, the way I see that seems a lot of money, but depends on customer retention. Because, for example, you could be paying, you could pay 2.5, you could be paying 2.5 to £4,000 to £5,000 a month for marketing. So you could actually, some people could be paying 20, you could be paying somewhere between, I mean, even in my business, we probably pay 18,000 a year for some form of marketing. So therefore, and I think we paid probably around 30,000 for our last deal. So I paid 2 years worth of marketing for 100 clients. But if I have them 100 clients more than 2 years, I've gained.
There you go. Exactly. Because it's a long-term value.
Yeah, it's the longer term gain of those acquisitions. So it's interesting you say that about acquisitions. So people will do acquisitions for there are fancy terminologies for them, but I won't bore everyone with that. But people buy acquisitions to gain more market share in their current business, in their current industry, to get market share in a market they're not already in. They'll buy in the supply chain so that they can then have that supply chain. Or they might do a mix of all to be a bit more risky, because they want to penetrate different markets to get access to different technology.
Exactly. It would be way cheaper to penetrate that market with all the risk and the expenses that have. And yes, people don't understand sometimes the long-term value of the client, right? You see I remember I have a tenant, yeah. I had a tenant in my property for the 15 years that we run our business, that it was paying me £900 per month for 15 years. Can you imagine? Only one room, yeah. Actually, the same amount to buy with that amount you can actually buy a property, if that makes sense, right?
Yeah.
So, and how much it costs to acquire this client? Okay, I just acquire one time, right? And then the retention is the thing. I think that not too many people put a lot of attention to retention, and it's one of the more things that come with excellent customer service and so on. You see all these internet companies, they give you 6 months for free for you to switch, right? Because they do understand the long-term value. Because after you change the internet, after you change it and it's going good, you will never change again. It doesn't matter how much it is. It doesn't matter if it's 20, 50, 30, you name it. If your internet works good, you only will change it when it doesn't work. But when it works, you will take any offer. But when it works, you will pay whatever, and you will say, don't touch it. I don't want to save even £1 in internet. I don't want my problem in internet, right? So those companies, they understand the long-term value of the client. So that's why they do this offer 6 months for free, this and that. Because, if at the end of the day you switch to that service and you stay years with that service, the long-term value of the client is. And
that's why I would say, when we go back to the pricing that we said, was number 2, what I'm not telling people to do is go all in at high pricing because you just feel you need the money now. Because this is why you have to do your pricing with your plan, and why your cash flow is important, because perhaps to get market share, you do go in at lower prices in the front end to get a longer term retention at the back end. So that's why you have to do the longer term plan, because if you just do a short term plan for 3 to 6 months, you'll just be going, oh no, I can't afford to sell that cheap because I don't earn enough money. That would be the mindset of most people. But if you did a 3-year plan and built that strategy up a longer period to see, okay, if I go in cheap here because I've got a certain product, or I'm trying to gain certain market shares. So it's not for everybody. Obviously, it depends on the industry and what you're doing. Because in 3 years, I'm going to have this, and then I'm going to exacerbate that, and then do an acquisition. Then you've got your strategic plan, haven't you? Because you've got the plan. So reviewing your pricing again doesn't always mean I'm saying you have to go in at full pricing. Not necessarily. What you have to understand is how do you maximize your strategy to make sure, because ultimately in the end, you just have to have enough cash flow to be able to keep it going. So as long as you trust in your strategy and you can have enough cash flow to keep it going, then you can kind of do what you want to a point, in terms of, your pricing and things, because don't listen to you should be charging this. You have to, your plan, numbers don't lie at the end of the day. Your plan will tell you if it can work. Yeah, it might go wrong. It might go off track and it might not work, but you'll be able to change it.
So, okay. And then what would be, Julie, the next step that we need to cover?
Okay. So then I would say the final step then would be sort of systems and structure. I think too many people rush into systems early on. I've seen people spend thousands of pounds on stock systems and then no one puts the stock in. I've seen people spend thousands of pounds on project management tools, but no one actually updates it or manages it. And I've seen people spend thousands of pounds on accounting systems and ERP tools, and then no one knows how to read the reports off the back of it. The whole thing's pointless. So I think I am all for systems and processes, but I don't believe systems fix bad processes. So I think systemization is important, but I think often smaller businesses can do things a bit more simplistic before they need the big systems, because they can just be expensive, and that people don't have the time or the people to then implement those systems to use them effectively. So for example, if you're going to develop your KPIs, if you don't know what your KPIs are, and it's absolutely fine to say you don't know what your KPI is, just be honest. If you don't know what your KPI is, you don't know what it is, so you can plan to work it out. But don't go and buy a system that's costing you £300 a month to report on KPIs if you don't know what your KPI is, because that's pointless. What you actually need to do is be better off to spend the £300 on an advisor to help you build your plan and understand your KPI, to then use the £300 to get the system afterwards.
Tell me about it. Tell me about it, because Lily spent a lot of time in TikTok, in all the social media, and they said this AI tool that do this, and then she's buying, and just last week I'm sitting with my IT director and I'm checking the accounts, and I see so many systems. I said, Lily, you don't even know the password for this, so and yes, is to have the right systems in place, is key in the organization. But at the same time, it's just to have the right system. Like, for example, we have over 60 websites, right, from that we develop from our own business or from clients that we have developed, right, in our server. So we do have a professional dedicated server. And I'm checking, and I said, why so much money for the server? It was coming quite high. I understand we do have a large number of websites, and I sit with IT director and we're checking, and we find a new server to put on the website, and was 1/3 cheaper. Yes, so we literally saving. Okay, we had to pay 2 years in advance, no problem, but we save 60% of the cost. And of course, we need to move the 60 website one by one, which is, but in 2 weeks we can do it. 2-3 weeks is done, and that's it. The whole thing finished. And I think with the system, in Aweber, our broadcast mailing the list, right? We have thousands of people there from Singapore, from London, from all the workshops that we have done all over the world. And of course, it costs a lot of money because they charge you for subscribers, for people that are in the database. And the database is quite large. And but then I'm looking at this, and I said, look, we have over 2,000 people that unsubscribe. So what these people are doing there? Delete them from the thing, So let's, I'm paying for 2,000 users more. I don't need them anyway. They already unsubscribed. They don't want to know. They don't want to know anything about me, So what's the point to have them there? So sometimes in the system, they are in place in the organizations. Today from my own experience, and sometimes we have to look deep, right? How much we're paying for it, how efficient they are. and how well they manage and how much are we paying. It's not because we see in a TikTok or in the whatever, this AI can do this and can do that. Okay, let's buy it, and then you keep packing and packing and packing. At the end of the day, there are a lot of systems of software around the company that you pay monthly that you never use. Saying that, I agree 100% with you.
I think people should just never be too proud to start small, because I sometimes see that, it doesn't always have to be thousands of pounds of savings. Sometimes the small things add up.
Exactly.
I mean, I went to companies of 50 million. I've seen companies of 50 million where you look at their insurance policies and they're still paying for employees they don't have. And that might save them 2,000 a year. Well, maybe to a 50 million, 2,000 a year, but it all adds up. Do you know what I mean? It all adds up, because the money you save is money for investment at the end of the day. So it doesn't matter whether it's £1. It doesn't really matter whether it's £1 or it's £10,000, because you're not always, if you're running quite efficiently, it's unlikely you're going to find tens and tens of thousands, because if you do, then you got a bit of a problem, haven't you? If you keep finding, but so it's the small wins. It is the small wins that add up. It's the small wins that add up in the end, because it doesn't matter if you save £1,000 and you take that £1,000 and you invest it in marketing, and then that £1,000 generates you £10,000. Then you're still better to have found the £1,000 in the first place, because you wouldn't have had that £1,000 if you hadn't have found it. So I don't think you should ever be concerned about it being too small either. You should literally, I do believe once a year you should evaluate everything. I mean, I review my costs every month basically. And what I'm doing, because we're with our acquisition phases and stuff like that. I mean, we're always doing it, but I definitely think you should review all costs at minimum yearly, to see what you're spending and what you're not spending, and to see where you can save it basically. But for me, systems and processes isn't just the system; it's the process of who's doing what. I think accountability comes into it, because sometimes you might be better, if you're going to invest in a system, lots of systems, if you add 10 systems, that could actually add up to a person. And it's well, actually, what's more effective in the short term, the system or the person? Because as an owner, part of it is, how do you run the business without you? So would the system stop that? Because someone still has to do the system. If you get the system, you might still need the person. So actually, if you didn't get the systems and you got the person can then help you build the plan to then see what systems you actually need, because now it's a weight off your shoulders. You've got a skilled person in that place to do the system. So to me, it's about who's the accountability of who you're relieving these tasks to as the owner, to take the strain off your own shoulders and things like that, because this is how we get overworked and overwhelmed, is when we're trying to do too many things.
Exactly. Yeah. Even a typical example of this is, the gala that we did, the ticketing, the ticket comes with the photo, right? And we did have we could build the system, yeah, but we didn't have time, and I didn't want to rush into it, yeah. So we actually did it manually, which is, we put a lot of work on our end, right? But because I think my first job in Spain was about software developing, so I work in programming computer for 5 years, so I understand, when you put the tech in place, right? If to put this is not about system, it's about to have the right system, right? And so something like important, like the ticketing, yeah. We did it manually, and the gala was successful in that, right? And yeah, of course, we're looking at how to automatize. Probably we will build the system, the ticketing ourselves, with our software developers, our own software developers. But at the end of the day, I think that systems can help a lot the business, right? If you have the right system.
Yeah.
It's
you have
not
to have
about
the right
too
system.
many, it's about have the least as possible and good ones, yeah. And like you said, the issue with the system that we have is because you pay monthly, you think it's little money, yeah, but then you have Zoom, you have a web, you have even we have a software that that look after the people that work from us remote, not even in United Kingdom, right? So the servers, the email, the text messaging platform, the this and that, when you add, it's like 10 system that comes every month and take one £10, the other one 15, the other one 50, the other one 100, the other one this. And yeah, I think that I check them once a year, like you said. But after this conversation, I think I'm gonna check them after 3 months. Yeah, because they get carried away, especially with Lily, the phone, the social media, the AI thing. She loves all that thing. This AI can do this, and can do the video for you, and can do. And at the end of the day, it's all those tools cost money. And once you are inside, you have to pay 20, 30, whether you use them or not, right? And it did affect the cash flow, because, like you said, it's you don't notice, but because it's so little money, you don't notice. But when you add this for a year, and when it's more than 1, 6, 7, it becomes a lot of money.
It does.
Yeah, I think that the system, Amazon, for example, the guy Jeff Bezos, right? The whole his whole success has been in systems, right? He's a master building process and systems, and that's why he's one of the richest person in the world, right? So how important is this to have the system and the process in place in the business, so things can fly. But saying that,
yeah, but I think you just have to be realistic, don't you? I mean,
exactly.
I think in the end, we all know that AI and systems is the way forward in the world. So the systems will be there. They will be important. But I suppose the point is that's the sort of thing you could acquire. So you could acquire someone that's already got the systems, as an example, because not everybody acquires for customers. Some people acquire for technology. So you could acquire, if you found someone that had all the systems you want and they're already functional,
very good. Yeah.
then you could acquire it to get their systems, then bolt your customers into their systems, as an example.
Fantastic,
that type of thing. So I do think systems are important, but I think organic growth businesses struggle to implement systems because of the time and effort required to do it. So you either need to do it slowly so that you implement them correctly, or you try and acquire them through your acquisition journey, or if you're partnering with someone, maybe it's not a full acquisition, it could be a joint venture or a partner, or so there's different ways to do it. But I think that you either acquiring them or you're growing them, and if you're growing them, you can try to grow them too quick. And again, it's back to the fluffy stuff, isn't it? Because people like the conversations, and they like and it distracts them from what's really important, probably, is the truth from what I see. So it's distracted, but then they just forget about it, and it's a small monthly amount, so they don't do it. But it's just a waste of energy, really, to do the whole thing in the first place.
And also the legacy as well. We find I was asked to do a talk once about the legacy, how to close the gap in with the technologies and the legacy, because it's not only changing technologies in the big companies, but also there is a legacy of the people that they used to use a system for 20 years, 15 years. They don't want to change. It doesn't matter that the next one is coming better. And 10, 15 years ago, everything was in the computer. Now everything is cloud-based and things like that, right? And even the operations are planning the cloud-based at the moment. And sometimes even you find in the organization resistance for people that, let's say, for example, a merger or an acquisition happened, and because of that situation, we have to apply a new system. This is why you were talking about the risk, yeah? How these people, the new people, will adapt to the new systems or new technology, or they're gonna have that legacy that no, we want to use this software or this and that also comes again to the risks and maybe to the rewards as well, because if the system is more efficient, maybe the company can produce more, right?
Yeah.
Yeah.
So they're my 5 steps.
I love it. So Julie, thank you so much. I think that for the audience, we have a very, very nice chat. If you took pen and paper when we started to talk, you are lucky, because you got a lot of tips that you can implement in your own business to grow it and to make an extra million. So thank you so much, Julie. The last thing that I wanted to add, if someone is listening to this podcast and they're looking they want to grow the business, they want to make an extra million, and they don't know, they don't even have financial planning. I'm not sure if the price is correct. They don't know where to start acquiring companies that sometimes even they can even acquire it with no money, and more things that we covered today about the systems in place and things. So how they can contact you, how they can access to you?
Yeah, so I'm on LinkedIn. I'm Julie Wilkinson. I have Profit Queen after my name, so I'm on LinkedIn.
I like it.
Yeah.
Perfect Queen, I love it.
I have the website, Wilkinson Accounting Solutions. You can contact us through there. I am on Facebook as well. I've got Wilkinson Accounting Solutions Facebook. And my email's a bit long, but maybe you can write it out. It's julie.wilkinson@wilkinsonaccountingsolutions.co.uk.
Yeah. Anyway, your details is gonna be there. Julie's details is gonna be there in the comments. Where we're gonna post the website and the podcast, and also in our social media. So there you go. If you are starting your business or you want to take it to the next level and you need help and you think that what we covered today, these 5 steps, can take your business to the next level, then you have Julie, which is amazing, that can help you. Remember, I always share with everyone that having a mentor and having a coach is one of the biggest things that can happen to you. There is no a single gold medalist that every time that he win a gold medal is said to the people that thanks to my coach, thanks to my mentor, right? So knowledge, the only difference that you have right now where you are and when you want to be is knowledge. Is the only thing. I was doing a talk the other day, and I was saying to the people that, if you take Richard Branson right now and you take all his money, everything, and you put it on the street, in 6 months he will be a millionaire again. Why? Because he knows something that we don't know, right?
Mm-hmm.
So everything is based in the knowledge. So if you want to grow faster and if you want to implement a more effective idea to your business, it's very important to work with the people that know, with the people that have the experience, with the people that actually have done it, wherever you want to be, and ask for help and seek assistance is, I think, the best position that every single one of you trying to grow your business can be. So on that note, thank you so much, Julie. You have been fantastic. You're a great speaker. Yeah.
Thank
All
you.
of you, tell everyone can follow Julie's podcast. So what is the name of your podcast? The
Build and Exit.
Say again?
The Build and Exit.
Okay, the Build and Exit podcast. Yeah, you can follow that podcast also, so you can keep learning more about how you take your business to the next level and make an extra million. Thank you so much. Bye, everyone.
Bye.
Follow us for more on charismatic speaking, leadership, exponential business growth, branding, marketing, strategies designed to help you monetize your knowledge, find true happiness, and manifest your goals and dreams.